Hi and welcome to Blocks. I'm Matt, and in this short video I wanted to show you how I use the Block software to review companies using my investment process. In this case I've chosen AF Legal Group, stock code AFL. It's not a stock that I've had a lot to do with, but it does seem to have been getting a little bit of attention, so I thought it might be interesting. So within the Blocks app, the first thing I do is navigate to the Investments tab. The stock code in here, AF Legal Group. And here is my personal investment process, which has a number of different investment factors. You can, of course, create your own process using the software. We give you a default suggested questions, but basically the world is your oyster in terms of what questions you want to ask of each of your investments. So how do I apply these factors for AF Legal? Let's run through them one at a time. So my first factor is balance sheet. How strong is the company's balance sheet? Obviously, a good balance sheet has lots of advantages. You can make M&A, you can invest in new products, you can avoid bankruptcy. In the case of AF Legal, if we have a look at the balance sheet, we can see they've got a net cash position, or total cash position of about $4.5 million. Offsetting that, they do have some deferred consideration for acquisitions, so 250 current and 850 deferred, so a little over $1 million. So your net, that reduces your net cash down to about 3.5. The other thing I like to check is just the net working capital position. Here you've got about 2.8 million of receivables versus 2.8 million of payables, so it's about naught. So a little bit of excess cash, about 3.5 million. So the balance sheet with that little bit of net cash is, I would rate fair to good. So in this case, I'll give them a good rating. Because the amount of net cash isn't huge in terms of the overall valuation of the company, I'll give this a low relevance factor. The second factor in my process is how well do the reported earnings reflect the economics and cash generation of the business, this earnings quality factor. There's really two elements of that in my screen, particularly when it comes to microcaps. The first is the absolute level of cash flows. Are they cash generative or burning cash? And the second is the cash flows relative to the reported earnings. In this case, we can see that the absolute cash flows of the business are positive at an operating level. Receipts less payments, what I call gross operating cash flows, a little over $1 million, and was about 1.8 million last year. Positive operating cash flow in both years. There is some ongoing capex, about $500,000 of capex this year, and of course the acquisitions, about $2 million of acquisition expenses on top of that $500,000 of capex. So slightly operating cash flow positive, so I guess that's a mild positive. The second check is how the cash flow compares to the earnings that the company is reporting. If we have a look at the company presentation for the latest results on the P&L, we can see a couple of interesting things here. One is the multiple definitions the company has of earnings. So they've got this operating EBITDA level, the underlying EBITDA, and then of course the statutory EBITDA, and obviously one line for the statutory NPAT. So quite a difference between underlying or EBITDA here of 4.7 million and a statutory loss of $500,000. So that's one little warning sign. The second warning sign here is that whilst they've given us a description of what these measures mean, they haven't actually given a reconciliation of how we get from this underlying EBITDA level of 4.7 down to the statutory EBITDA of approximately 800,000. Now, there's obviously a lot of complexity in the accounts due to the 3 or 4 acquisitions I've made during the year. It is understandable there needs to be some adjustments. So I think what we've got here is more a case of complexity rather than any deliberate attempt to obfuscate the numbers. But the upshot of it is the company is suggesting that they've got underlying EBITDA of 2.7 million, and the gross operating cash flow for the year was about 1.3 million. So that's quite a difference, especially when you consider there was about $700,000 worth of share-based payments in the earnings. So that should boost the cash conversion of earnings. So the fact that we've only got we've got less than half the cash flow back in the earnings suggests that the earnings haven't been conservatively stated. As I said, I'm going to give them the benefit of the doubt in this case that there's nothing particularly sinister in those numbers. It's more just reflective of the complexity of the business, but nevertheless I am going to give this a below average rating for earnings quality and a because I don't think it's sinister, I'm just going to give that a low relevance factor. So now's where we get on to the interesting part, which is the returns of the business. If this factor, I'm talking about the ability of the company to create value through improving returns. And there's two elements to this, and all companies are a combination of these two factors. The first is the ability to improve returns on existing capital, and the second is the ability to deploy new capital at attractive rates of return. In the case of AFL, there's obviously a little bit of both of these factors. In terms of the existing business, they're looking to gain scale and improve efficiencies as they integrate existing acquisitions and start to get some of the benefits of opening up a number of new offices, etc. But I think the really big driver of returns and valuation for the stock going forward will be how they deploy capital in the roll-up strategy. So the easy thing to answer here is that returns is clearly our most important factor to consider. Now, what about the rating? In my experience, there's generally two sorts of roll-ups. On one end of the spectrum is where you acquire a business and you can significantly improve the economics by bolting the acquisition onto an existing network where the cost base is much lower. Smaller players tend to have high cost structures, so they sell their businesses quite cheaply because they're not making a lot of money, but when the scale player buys them, they can take all the costs out of the business, and therefore the effective acquisition price ends up being a very low multiple of earnings. A couple of classic examples of this in the last 20 years would have been Computershare and Sonic. In the early days, Computershare had the back-end technology for share registries, so they were able to buy the front-end share registries quite cheaply and then plug them into their existing technology and get significant margin uplift. And Sonic were able to buy a lot of pathology labs and put all that volume through one centralised big lab, and so they had sensational marginal economics as they went through that roll-up. At the other end of the roll-up curve, you've got the public to private arbitrage, where you are basically buying private companies at very cheap multiples and funding that through the issue of scrip that's listed on public markets at much higher multiples. You can often get really excellent early success in these sort of roll-ups because you're getting great EPS growth, but often you can find that these roll-ups end in tears over time as what appear to be cheap upfront multiples get undone by various diseconomies of scale as the businesses grow. A classic example of that in the last decade would have been G8 Childcare, buying business on 3 to 4 times EBIT, but found out that the long-term returns from that roll-up weren't anywhere near 3 to 4 times EBIT as the demographics changed underneath those centres and high head office costs took away a lot of that value. So they paid 3 or 4 times EBIT, but they never got that sort of long-term return on equity. Obviously, in this situation, we have that combination of the two. We're looking to buy private law firms at cheap multiples and also to improve the efficiency on the back end. The bullish thesis on AFL is that they can create a scalable corporate platform that enables them to easily bolt on lots of private law firms or lawyers in a lateral hire type of arrangement. That's true to a degree, I think, but as in all personal services businesses, there's going to be a natural cap on returns in that process. The personal services providers, whether that be lawyers, accountants, IVF specialists, radiologists, whatever, have generally got an ability to retain a large share of the excess returns for themselves. So if the corporates get too greedy, the lawyers end up leaving. If you think of it, even if AFL is very efficient at running a law practice, for an individual lawyer, they might find that 100% take of a much lower pool of profitability is actually a lot better than just getting 50% of a larger pool of profitability. So you tend to find that these personal services roll-ups they reach a sort of natural margin equilibrium and staff equilibrium that prevents them growing much further. It's sort of instructive that there's not too many successful large listed personal services firms. The leading law and accounting firms all remain private, and on the medical space, the radiologists and the IVF roll-ups had good initial success, but they've then struggled to follow through on that. So this is really the key issue for AFL, is this ability to trade off some benefits from giving corporate scale versus the individual rewards that the lawyers want for working at the firm. For this reason, I'm only going to give the returns a fair rating, but I think you need to be cognizant that if they are buying things cheaply, in the short term, numbers might appear a whole lot better. Onto the governance factor. This is basically a combination of the quality of the management and the incentive structures in place. In the case of AFL, I haven't followed this stock for long enough to have strong opinions on management. I do think it's interesting that the former MD decided to step down to concentrate on where he thought his operational skills could add value to the business and to donate shares to other directors. So that suggests a certain amount of skin in the game that is often lacking. On that basis alone, I'm going to give it a good rating. And because of the importance of execution to this roll-up strategy, I think this is a factor that you really want to have strong confidence in. I think it's quite important to the whole game. The business factor, how strong is the business franchise and how established is the business? So a couple of ticks for this as a sort of micro cap in that it does have revenue, it is an established business, it's nearing statutory profitability and is reporting underlying profitability and some positive cash flows. And against that, it's got a very good industry thematic. You've got an industry that's likely to be growing over the next sort of 10 to 20 years, and it's a very fragmented industry with no established players. So there is the opportunity to establish a semi sort of leadership position. So I'm going to give this a good rating as well. And the fact that there's industry tailwinds makes this a moderate rating. Moving on, we get to valuation. I like to split my valuation into two factors. The current valuation of what is the business worth in its current state, and then looking forward, what might the business be worth in 3 to 4 years. And that gives me an idea of what the sort of optionality is within the business. Within blocks, you don't rate the valuation factor. You enter your valuation and the app will determine the rating based on the current share price and what you can configure that ratio of share price to valuation to be. I do think valuation is an art. I like to just go with some heuristics around multiples of sales or earnings to get some broad parameters for my valuation. In terms of what the business might currently be worth, these personal services businesses tend to trade around 2 times sales, possibly a little bit better if margins are higher, but also the potential for down the 1 times range if you start to get personnel issues. If you think of a business that might be making mid-teens margins and trading at mid-teens. So in this case, if we assumed 2 times sales, about 18 million, and as I said, broadly not much debt, certainly not too much surplus cash. That would equate to about 50 cents per share. And because we are currently at 49 cents current share price, that comes up as an average valuation rating in my system. Anything that's within 20% of the share price is regarded as average. If we're looking forward 2 to 3 years, and let's assume that the company continues on its roll-up strategy and is able to acquire an additional 20 million of revenue for around 10 million in capex, and assuming they get some scale benefits on that, we could say 3 times 40 million. Sales equals 120 million, less the 10 million of capex to acquire those businesses. That gives about 110 million enterprise value for the business. On the current share base, that'd be about 150. That gets an excellent rating because obviously $1.50 is about 3 times higher than the current share price, over 100% above the any valuation target, 100% above the share price in my system gets an excellent rating. Then the final factor is momentum. How is the business travelling at the moment? Obviously, companies presenting some pretty attractive metrics in terms of underlying revenue and EBITDA growth. And as the company gets the full benefit of recent acquisitions, they should at least be able to report good underlying numbers. Query, as we said, whether the cash flow is there to justify those exact numbers, but certainly some good momentum as far as the market is concerned. So I'm going to give that a a very good rating at the moment, and I'm going to give this a moderate relevance rating. So that's my rating system. As I said, what I'm trying to do is get some broad parameters to work out where I need to drill down in. And in this case, it's really the returns. That's the most important figure here. You've got to get comfortable that what the sustainable margins will be for this business, and therefore their ability to add value through the acquisition process. As always, I don't make any recommendations here. This is just an initial rating under my system. It doesn't mean I'm going to buy or sell the stock I currently hold. No position. It's really just a demonstration of how I use the software to evaluate companies. I hope you've enjoyed that. If you want to keep up to date, you can follow us on Twitter or create a free account within Blocks and keep up to date with all the postings on our blog and technology roadmap in the future. Thanks for listening.